I think what this really is, the BRICS understand. Yes, they want to break free from Western financial dominance. They want to break free from the dollar. They also want to break free from the price setting mechanism. It's a big deal, and people should not lose sight of the significance of this happening. Even a quasi gold-backed trade system would be enough to start to really derail the settlement status of the US dollar. To me, silver is, from a standpoint of risk versus return, I don't know that there's a better place on the planet, honestly. And when you see the amount of deliveries, that signals to me big institutional smart money knows that and is doing all they can with the price in order to reposition into much sounder footing moving ahead.
The global financial landscape is shifting, with increasing talk about the potential for BRICS nations to move away from the US dollar and explore alternative systems for settling trade. One of the key developments in this shift is BRICS' initiative to create its own precious metals exchange, aiming to challenge the Western-dominated pricing mechanisms of institutions like COMEX and the London Bullion Market Association, LBMA. This is part of a larger strategy by BRICS countries to reduce dependence on the dollar and break free from Western financial dominance. By establishing a more localized system for precious metals trading, these nations could significantly weaken the dollar's global influence. Andy Schectman, CEO of Miles Franklin, points out that the rapid accumulation of gold by BRICS nations plays a pivotal role in this evolving financial landscape. As they continue to increase their gold reserves, BRICS countries are positioning themselves to challenge the dominance of Western financial institutions. According to Schectman, their growing reserves and the push for alternative trade systems signal a challenge to the US dollar and a broader shift toward economic autonomy. This strategy includes the development of new trade infrastructures, such as systems that bypass traditional Western intermediaries like SWIFT, and could involve the creation of a digital or decentralized financial network. By moving away from the control of global financial hubs, BRICS is setting the stage for a system that allows nations to trade freely, using gold or local currencies, without the constraints imposed by dollar-based systems. This shift could offer countries greater financial independence, ensuring they are not subject to the political pressures often associated with the dollar's dominance. If BRICS nations succeed in establishing a trading system backed by gold or local currencies, it could signal a major shift in the global financial order. While such a transition won't happen overnight, the groundwork is already being laid, and the long-term effects could reshape global trade dynamics. As BRICS continues to strengthen its gold reserves and build infrastructure to support independent trading, the prospects of a new, gold-backed trade system gaining ground become more plausible. Now, we present the clips from Andy's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Enough countries start settling trade in their local currencies, especially if they're backed by or anchored to gold, even loosely, you're looking at a major challenge to the fiat system. And again, much like most people who have talked about this have said, it won't happen overnight, but it is. You are watching the foundation shift. These are the countries that have been buying all of the gold, and these are the countries that produce all of the gold. These are the countries that have developed the technology, whether it be the bridge technology or others that have come into being recently. They're the ones who not only understand what gold really is, accumulate it all, produce it all, but now have trading mechanisms in place to trade cross-border with free from the SWIFT interference. And I think what this really is the BRICS understand. Yes, they want to break free from Western financial dominance. They want to break free from the dollar. They also want to break free from the price setting mechanisms. The fact that COMEX and the LBMA, which really are rather, let's just call them fugazi, right? What they are very fractionalized. They are very rehypothecated. And if everyone stood for delivery, overnight the markets would blow up. There is far more paper on the Western exchanges than there are bars behind it. As we were mentioning earlier, the LBMA, which is a T+1 settlement, in 3 days you should have your metal or it should be on its way to you, is now T+8 weeks. Well, they're saying it's a lack of manpower and trucks, or is it? You got guys like David Jansen saying that they trade 2.9 billion ounces of silver per day, 3.5 times annual global mine supply. And behind those 2.9 billion ounces are only 65 million ounces of physical silver. There's a problem there if everyone stands for delivery. And the same thing is true with gold. Somewhere in the neighborhood of 36 million ounces, I think, is the number of gold that is standing behind 280 or 90 million ounces in spot contracts. Really? So if every one of those contracts stand for delivery, what happens? And maybe that's why they pumped the BRICS. And the BRICS, as I've been saying on your show and others for 4 years, have been exploiting this by slowly. This is the little by little part. This is why I love the logarithmic decay, little by little, then all at once, because what we have been seeing for 4 years is the little by little by little by little draining of the exchanges, starting with the LBMA and moving all around the globe. You even see the draining of the Shanghai Metals Exchange, but that's for a different reason. That's because the Chinese are telling their people through the Shanghai Metals Exchange to save in gold and silver, and they are state-sponsored savings programs, so there are lots of deliveries. But on a bigger level, to see the LBMA be massively drained of its gold and silver and the COMEX, to see a change in the T+1 to T+8 weeks as a result of all of this demand standing against a fractional Fugazi system. And by the way, that's the same environment that the Hunt brothers realized in 1980. Way more contracts than there are bars. Let's buy up all the contracts and stand for delivery. Really, that became a problem, and the COMEX did what it could to save its own by changing the rules. But the LBMA is not an exchange like the COMEX is. There's no central clearing authority. There's no exchange to make rules. It is an over-the-counter, peer-to-peer trading network, much less regulated, much more opaque. And you're talking some of the biggest banks in the world are really in a very, very dangerous, I say, existential threat position by being wickedly short, without the ability to get those bars for delivery if requested. And what's really different now more than ever before is the standing for delivery. And when I started talking about this in 2020, I would say, look, less than 1% of all these COMEX contracts ever stood for delivery. Same thing is true on LBMA, not a lot. And now all of a sudden, this is the Achilles heel. This is what the BRICS countries understood. This is what the Trump administration understands. This is why we've seen north of 50 million ounces of gold delivered since November. This is why the U.S. has become a net importer of gold since November. This is why we're seeing the largest deliveries of gold and silver into the COMEX ever, because they understand this. And they called it Trump tariffs. No, it's not Trump tariffs. It's that this administration, Scott Bessent, when he was, before he became Secretary of Treasury, he was running a hedge fund. His largest position was gold. Judy Shelton wants to issue 50-year treasuries pegged to gold. She told me Trump plans on doing this July 4th next year, the 250th anniversary of the country. She said he's going to do it. We've talked about it. Well, we'll see. But if you're going to peg gold to a new system, to a treasury market that has lost demand, that is weaponized, that is seeing since no new net buying by central banks since 2014, it's because of the lack of trust. It's because of the mismanagement of the system. So, yeah, I think it's a real deal. It's a very big deal. And because of the way the BIS, which is a Western institution, pulled out of Enbridge at the 12th hour, embarrassing, humiliating the BRICS countries, I don't think they're going to be open or forthright or candid or transparent about anything moving forward. I really don't. They're just going to get their ducks in a row. They're going to continue to do this stuff. They're going to be much more closer to the vest. And these are the kind of things that are happening in real time. I think it's a big deal, and people should not lose sight of the significance of this happening. And even a quasi gold-backed trade system would be enough to start to really derail the settlement status of the U.S. dollar, which ultimately impacts its reserve status. It's a big deal.
Silver is increasingly recognized as one of the most underappreciated assets in today's market, often overlooked despite its significant potential. Its price has experienced considerable volatility, dipping below $30 per ounce before recovering to $32.20, reflecting its inherent swings in response to market forces. Andy Schectman highlights that silver's dual function, as both a monetary store of value and a crucial industrial metal, makes it particularly sensitive to macroeconomic shifts. Industrial demand for silver, especially from fast-growing sectors like technology, renewable energy, and electric vehicles, further amplifies this volatility. Unlike gold, which has long held a stable position as a go-to safe haven asset, silver's more active role in modern industries makes it more susceptible to rapid price movements. Institutional interest in silver is growing rapidly, as evidenced by record deliveries on the COMEX and LBMA exchanges. Over 50 million ounces of silver have been delivered since November 2023, signaling strong demand from institutional investors. The LBMA, which facilitates $2.9 billion in daily silver trading, 3.5 times the annual global mine supply, has faced extended settlement times, moving from T+1 to T+8 weeks. This growing strain points to increasing pressure on the market, as silver's fractional reserve structure, with only 260 to 265 million ounces of physical silver backing LBMA's paper contracts, exposes it to systemic risks. Such vulnerabilities echo the disruptions seen during the 1980 Hunt Brothers silver squeeze, suggesting that a similar event could occur even more if delivery demands continue to escalate.
It's the most undervalued asset on the planet. I think asymmetrically, there's nothing like it. Low downside, high upside. But what's really interesting is while the price took a hit, we're seeing huge deliveries, which we've been talking about for a while, coming from the LBMA into COMEX. And this is not retail flow. It's serious money positioning behind the scenes. Look, silver's still in a structural deficit. And when you talk about solar, electric vehicles, green tech still roaring, let's not forget the military-industrial complex and its need for silver. To me, it's a coiled spring. And if it breaks through 30 again and holds, which obviously, where are we today? We're well above 30. So let's see, what are we at here today? Let me look and see. So I know it's a down day today. We have silver at 32.20. So breaks through 32 and holds, which it has. Upside is the upside potential on silver, Jesse, is it's off the charts as far as I'm concerned. And when you see the LBMA at this point having 260 million ounces of silver standing behind what amounts to 2.9 billion ounces in daily trading, 3.5 times annual global mine supply. When you see a situation where the LBMA has gone from T+1 to T+8 weeks, they're being drained. When you see the amount of deliveries coming into COMEX, off the chart deliveries, again, this is not retail. I think silver to me is strategic. It's not industrial. And I think it's an existential threat to some of these big banks who have been doing all they could, let's just say behind the scenes, to position themselves, maybe to slowly pull away from these massive leverage short positions. At least the smart ones are. And maybe that's what a lot of these deliveries onto COMEX represent, the bringing a reshoring of gold to back these leveraged and naked short positions, which very quickly can turn this whole thing upside down. So look, you get through 35 is really what I mean. Then you're off to the races. You can look at 30, you can look at 32. These are certainly numbers, that big round numbers that silver's had a hard time getting through for a long time. But the real number would be to get through 35, and from there it's off to the races. To me, silver is, from a standpoint of risk versus return, I don't know that there's a better place on the planet, honestly. And when you see the amount of deliveries, that signals to me big institutional smart money knows that and is doing all they can with the price in order to reposition into much sounder footing moving ahead. The retail side of things has been completely and totally left barren by the mainstream. And with gold roaring at all-time highs and silver still only 60% of its all-time high, with the fundamentals that it truly enjoys, it to me is something that I'm rather surprised has been ignored by well-read, sophisticated traders. That won't last forever. The retail market has, other than the hard asset community, wouldn't know a silver eagle if it fell on their foot collectively. So I think to not have some exposure to silver right now is a generational mistake. I'm sincere about that. Hope people can sense that.
If the world moves away from the dollar, even gradually, it could significantly alter the investing landscape. Traditionally seen as stable investments, U.S. stocks and bonds could experience lower returns as a weaker dollar reduces their appeal to foreign investors, prompting some to seek alternatives. U.S. Treasuries have been a cornerstone of global reserves for decades, with countries relying on them as a safe asset. However, if central banks begin diversifying their holdings, demand for American debt may decline, potentially forcing the U.S. to raise interest rates to attract buyers. This could lead to higher government, business, and consumer borrowing costs. In this environment, gold could reassert itself as a preferred safe haven. Its enduring status as a stable store of value makes it an attractive option for investors seeking to hedge against the risks associated with a weakening dollar. As the dollar's dominance wanes, gold could experience increased demand, reshaping global financial dynamics and prompting a shift toward assets less reliant on the dollar. That's it for today. Share your thoughts on Andy's in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.